Hi, everyone. Today we are diving into an essential aspect of accounting, the comparison between the general ledger and the trial balance. To kick things off, let's start talking about the general ledger. As I've mentioned in my previous episodes, the general ledger is like the backbone of your company's financial records. It's a comprehensive, organized record of all financial transactions that have occurred within your organization. The general ledger is designed to provide a detailed breakdown of all of your financial data, including the entries for every transaction that affects your company's financial position. These entities are categorized into various accounts like assets, liabilities, equity, revenue, and expenses. Each account in the general ledger is like a chapter in the financial story of your business. When you look at this ledger, you can see the history of every transaction that's taken place, from the acquisition of assets to the payment of bills. Now, let's talk about the trial balance. This is something that I haven't covered in previous episodes. So let's talk about what it is. The trial balance is a summary level report that lists the balance of all accounts in your general ledger. It's a snapshot of your company's financial position at a specific point in time, typically at the end of an accounting period. The primary purpose of the trial balance is to ensure that your debits and credits in the general ledger are in balance. In other words, it helps you verify the accuracy of your accounting records. So now let's compare the two. The general ledger and the trial balance are like two sides of the same coin. They're intimately connected, and one relies on the other. While the general ledger provides a detailed record of individual transactions, the trial balance takes that detailed information and condenses it into a format that's easy to review and analyze. When you're comparing the general ledger and the trial balance, there are a few key differences to keep in mind. Number one is timing. The trial balance is typically prepared at the end of an accounting period. It's most common for this to be run on the last day of the fiscal year, but accountants can run it monthly, quarterly, and semi-annual as well. On the other hand, the general ledger is updated continuously as transactions occur. Number two is the purpose. The GL is a dynamic tool for recording transactions, while the trial balance is a static report that is used for verification purposes. And number three is errors. Discrepancy between the two can indicate that your accounting records have errors in them. So, speaking of discrepancies, let's talk about some common ones that might arise when you're comparing the GL and the trial balance. These discrepancies can be warning signs of issues in your accounting processes. The first common issue is unrecorded transactions. Sometimes transactions are missed, right? We're only human, and they're not recorded in the GL. And then that omission will result in a discrepancy when you're comparing the trial balance to the GL. The second issue is incorrect account balances. So if a transaction is recorded in the wrong account, it could cause imbalances between the GL and the trial balance. Third, of course, data entry errors is another common problem. Typos, you can transpose numbers, or just general data entry mistakes can lead to discrepancies between the two. And finally, there could be timing differences. If you record transactions in the GL on one date and then in the trial balance on another, especially if there's a delay in updating it, that can lead to some problems as well. So, what can you do when you identify these discrepancies between the GL and the trial balance? How do you fix them, right? It's essential to resolve these as soon as possible to ensure the accuracy of your financial records. First, you got to identify the source of the discrepancy. Is it due to an unrecorded transaction, an incorrect account balance, data entry error, timing? Like, what's going on? Obviously, once you find the source of that discrepancy, you have to fix it, right? So if there's a missing transaction, record it in your GL. If there's an incorrect account balance, move it to the right account. For data entry errors, obviously, you just need to make the entries to correct that. And then for timing differences, just make sure that your reports are both for the same dates and that you're recording things in the right period. Once the issue is resolved in the general ledger, update your trial balance to reflect those changes. And then they should match each other. And if they don't, you need to keep investigating, keep finding those errors and making the needed corrections. So let's talk about the importance of reconciliation. I've harped on this a lot in some of my earlier episodes and all over our social media. Obviously, reconciliation is key to ensuring that your general ledger and the trial balance are in sync. We talked about this earlier, but reconciliation is the process of comparing and adjusting the balances in both the GL and the trial balance to make sure that they match. Regular reconciliation is crucial for maintaining the accuracy of your financial records and for detecting errors and discrepancies. And once you know that the numbers match, you have the confidence and reliability of your financial data that you need to make decisions. Let's talk for a minute about automation and accounting software. In today's world, many organizations use accounting software and tools to maintain both their GL and their trial balance. And these systems can totally simplify this reconciliation process and reduce the risk of errors as you're going along. Automated systems can help catch discrepancies between the two, the GL and the trial balance, in real time, which obviously makes it easier to identify and correct these issues as soon as you can. The longer you wait to fix something, the harder it's going to be because you have to remember what you talked about a month ago and so on and so forth. So, you know, you always want to catch the errors as you're going so that you can fix them while it's fresh on your mind. They also streamline the process of recording and categorizing transactions. It's important to note that even with automation, regular review and manual reconciliation are still necessary to ensure the accuracy of financial data. I've learned just with a lot of accounting software, everything is trying to be smart these days. QuickBooks is trying to be smart. It's trying to guess based on historical transactions where something should be categorized. And if you're just clicking match, 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 you know, there's no guarantee that that's right. That's just their AI thinking that it needs to go to a certain place. It requires human interaction. You have to be the one to go in, match the transactions, make sure everything's in the right account, make sure that it's going correctly to your GL, and that everything is tying to your trial balance. So, yes, automation is great, but just keep in mind that these systems, they're not perfect, and you still have to know kind of what's going on to make sure that things are being categorized correctly. All right, in conclusion, the GL and the trial balance are two essential tools in the world of accounting. While they serve different purposes and have different structures, they are interconnected and rely on each other for accuracy. Discrepancies between the general ledger and the trial balance are not uncommon, okay? So don't freak out if they don't match. The key is regular reconciliation and attention to detail, because that is how you're going to correct those issues and maintain accurate financial records as you go. Thanks for joining us on another episode of Accounting Recounted. I hope this discussion on comparing the GL and the trial balance has shed some light on these vital aspects of accounting. Thank you so much. If you have any ideas of new episodes that you would like me to cover, please reach out on social media or on our website.